Hello, hello, hello. Whoopsies. Hello, hello, hello. How's everyone doing today? Welcome to Al Stock Trades. All right, so um, a couple things happened today. It's predicted, but they just released an S form earlier today in regards of you know in the lines of stock work compensation. You can read the form here when you do your due diligence. But overall, Palantir has done this. Many companies, especially in the technological sector, they ultimately do this to retain talent and to retain developers as they have a piece of ownership of the business. Um, what I'm going to go ahead and do in this video, and I haven't done this before, right? This is something that I haven't done is I'm going to do an intrinsic value calculation with a 100% dilution. Yeah, you heard that right. We're going to go ahead and dilute the stock price by 100%. Okay. So right now, on average, they have around 500 million shares, right? Assuming that the 32 million gets processed, they're going to have around 500 million, let's say, on average. We're going to go ahead and assume a 100% dilution. So instead of 500 million shares in our intrinsic value calculation, we're going to go ahead and we're going to put 1,000 million shares, equivalent to 1 billion shares. Okay. So, if you don't recall, we can go ahead and go on our terminal here. If we go to earnings call, we go ticker symbol CLOV. We go, I think it's the fourth quarter, 2023. We go ahead and do that. We pull the earnings transcript for Clover. And we're going to go ahead and search Andrew Toy when he talks about return to growth. Here it is. So we'll go ahead and kind of push this in here and we'll just highlight this. This is again from the earnings report. This is the transcripts. We will then be in a position to return to growth during a period where we anticipate our competitors will be retreating, and we'll aim to continually build the strategic lead that we develop. So let's go ahead and just hit growth. Lead to sustainable growth, advantage over our competitors, yada yada. Will allow us to expand our positioning from steady profitability to higher profitable growth. Let's see. Let's continue here. What else? So while we're managing the plan to a little bit flat, a little bit down, growth is not our main focus right now, right? We do expect to see a significant continued improvement through plan operations and through member mix, where we would see that yada yada yada, and therefore one would drive revenue growth. So they basically tell you that this year growth is not going to be, here. So the likely growth in 2024. Let's see what else we have for growth. Okay, if I could slip another one in, you said return to growth. I'm curious timing of that. What exactly are you I guess insinuating with the comment, because they're not specific. So Andrew Toy goes ahead and then says, let me just go ahead and read this here really quickly for you guys here.
Yeah. So what you're saying is that we absolutely have been focused on just the EBITDA profitability, and they adjust the EBITDA profitability without the need for additional capital, right? So that's been our focus. It remains our focus, and we are driving business in that.
All right, let's go ahead and read this. So yeah, so we're saying there is that we absolutely have been focused on adjusted EBITDA profitability and attaining adjusted EBITDA profitability without the need for additional capital, right? And so that's been our focus. It remains our focus, and we are in striking distance of that, and I feel good about it. That means that because that has been the priority, we have not been focused necessarily on membership growth during this period. Again, when they don't focus on growth, people want growth. When they focus on growth, people want profitability, right? And I think that's appropriate. So I also think that that has been a good strategic move on our part, because those people who really took on a lot of PPO risk and didn't have managed those management capabilities, I think have had seen it to be difficult for them to manage their performance because they don't have something like the Clover Assistant. I think he's talking about Bright Health Group that rebranded. Now, we've been focused on a lot of things in the last couple of years, maturing as a public company, maturing operations, yada, 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 doing all these things, and we all, a bit of growth, zero pathway, deliver profit, and then stop to say to ourselves, we've matured our platform, we've matured yada, yada, and then here it is. And again, growing the top line while still enjoying optimizations that we've delivered in the last couple of years, aka the profitable 80,000 members that are predictable. So what he's basically saying here is they're going to be returning back to growth, and ultimately from that's what's going to happen. And they're trying to do it without the need of additional capital, right? But let's just say we don't believe what Andrew Toy's saying, right? So if you don't recall, back in 2021 or 2022, Clover Health was growing at 100% year-over-year growth. They were growing rapidly, right? It was unprofitable growth, but they were growing rapidly. So it's not like this company doesn't know how to grow. I mean, they were at $3.47 billion in the fiscal year. Okay. So what they're saying is that they're going to return to this growth once they become essentially profitable or adjusted EBITDA profitability. The issue that I'm having, and a lot of folks on our stock terminal, is that, well, they're going to have to need to raise some form of capital in the future, because how are you going to sustain this growth? I'm drinking coffee. Sorry. It's either going to be two things. My throat, I've been really dehydrated lately. Been, studying a lot and drinking coffee. So overall, there's two ways. Either their profitable side of the business offsets this growth and they become kind of free cash flow optimal, and they just use the business money from their insurance side to fund the growth side. So there's that way. But let's assume the worst. Let's assume they do have to dilute. And in fact, let's not do a 10%, 20, 30, 40. No, let's do a 100% dilution. So they have 500 million shares now. Let's go ahead and bump it up to 1 billion. So now let's go ahead and say 1,000 million, right? 1 billion shares. Okay. Now, if you don't recall, they were growing at one point at 100 and something percent. So to make it simple, let's go ahead and have them grow at 45%, because I believe if they are going to be diluting 100%, they are going to be growing rapidly. You're not going to dilute shareholders by 100% and then not grow more than 100%, right? But let's say they're going to grow 45%, okay? So let's take the revenue here of 1.23 billion. Let's do our 5%. We get 61.5. Let's go ahead and go 10 years out, and let's grow them at 45%. If you grow them 45%, you get a bull case of $16.20, okay? Now, let's go ahead and let's assume that they even if they grow 45%, you can have that $16.20, and that'll be $8. So the roof of Clover, if they dilute shareholders, okay, if they dilute shareholders, the roof of Clover would be anywhere between $8 to $16, right? Now, if they manage to not do a dilution, then you can see the difference. We're looking at a $16 to $32 stock price, okay? But if we do a 1 billion share, like a 500 million share dilution, Again, I'm not including reverse stock split here because reverse stock split doesn't change the equation. If we do a reverse stock split and we do a reverse stock split with a of 10, 1 to 10, the stock price would be 162, but you would just multiply your average by 10. So if your average was $2, your now average will be $20. So stock split is reverse stock split, and stock splits don't change the equation. They just, it's just a algebraic equalization off of both sides that unfortunately your skill system didn't teach you, right? So some of you might understand this, some of you may not, right? So in terms of most penny stocks dilute, yeah, penny stocks under $5, it's different. I would say market, you got to look at market cap, because to me a penny stock is like a $20-30 million market cap. Like Mullen is a penny stock, right? So I would figure out kind of what's the definition of penny stock. So ultimately, if Clover can grow, which we know, let's say 25% growth rate at $1,000 at a billion shares at a 25% growth rate, we're looking at a max of $4 with 25 cents. That's why I said that if they are going to dilute shareholders by 500 million shares, they need to have a high growth rate. You put a high growth rate on there, you get $16, but you can half that and call it $8 to be conservative. Now, if they don't dilute and they have 500 million, and let's say that we do 25% growth, you can see we get that $8, which is why I half that bull case. So I think if we do dilute, I think the roof of Clover is going to be anywhere between $8 and $16. So that means the roof of Clover is going to be anywhere between a $4 billion market cap all the way to a $8 billion market cap, which is why kind of Chamath is butthurt, because he brought the company at a near $4 billion valuation. So it's like all this time it gets back to its $4 billion. That's kind of where I'm looking at this. So okay. So now I'm giving you the data that I already know and that we've shared with our stock terminal members. Well, what do I see from this? Well, clearly, even with let's just assume the worst. A 50%. Let's just assume the worst. 100% dilution with only a 25% growth rate, like literally low growth, right? A 25% growth rate. That's a $4 stock price. Okay, you go ahead and put 80 cents a share. We're looking at a 400% return. Okay, so we are still undervalued. Okay, I think they're going to grow at 45%, which is what brings us to that, 10 bagger, potentially 10 to 20 bagger, right? But assuming right now the worst, if they grow 0% with a 100% dilution, the stock price is trading at around 68 cents bull case for a 100% dilution with a 0% growth rate. And that's funny because it's literally trading near its 100% dilution with a 0% growth rate. So that's what the market's looking at it right now. This is, to me, incredibly undervalued. Okay. So that's kind of where I'm looking at. So I expect Clover to, it's in the transcripts here, return to growth. They're going to get to a return to growth period. And, once that happens, they're going to remember, they used to grow at over 100%. So modestly, we'll say 45%. And if they don't dilute, then we would be around $32 stock price. If they do dilute, we'll make a really shitty dilution. We'll do a 100% dilution. That's a $500 million raise from today's value approximately. That's a $16 stock price. Let's say you want to be extra conservative. Okay, let's divide that by 2. $8. That's like literally a 50% discount rate. Okay. Or not a discount rate, but a 50% cut off of the price. So this is kind of what that I'm doing, these projections, these what if projections, to say, like, for example, you own a business, and let's say you and your brother owns the business. You own 50% of the business. Let's say you diluted your guys' selves 100%. Instead of owning half of the business now, you own 25% of the business. That's what I'm trying to do right now. I'm trying to see is there still value in this company? And the answer is yeah. I do believe there's still value in this company. Okay, so Al never sleeps, always putting out good content. Glad Clove has you in their corner. Appreciate it. Al is the only analyst out there covering Clover. Sup, man? Okay, Al, you broke me. Your cute Trump personality always gets me. I am down to $20 average. Holy shit! Most penny talk just to set sell price. Won't price go down if they issue more shares or dilute? So if they go ahead and dilute, yes. So let me show you. So right now, let's just grow. Right now, Clover at, let's say, 500 million shares. Let's bring it in, all those 30 million shares. Right now, Clover is trading at a 0% growth rate with 500 million shares outstanding. Okay. If they were to dilute shareholders right now by 50%, yes, you see the stock price literally dropped. Okay. They dropped by half, right? Because it's divided by the number of outstanding shares. Okay. So yes, the stock price will go down. However, why am I okay with this? Well, because if the revenue, if they use the money to increase revenue, then if they bump up revenue by 45, you could see the stock price is higher than the $1 when it was growing at 1%. Does that make sense? Again, it's a complex equation, guys, with revenue growth. This is not just, that's the problem. Like, this is not just like one equation. You have a revenue in the numerator, you have shares outstanding in the denominator, so there's a lot of things going on with this equation. Okay. So hopefully this does make sense. You're gonna have to watch it back again. Okay. Exactly. It's undervalued. So you understand what I'm doing, right? I am doing a 100% dilution. I'm saying if Clover dilutes us with 500 million shares right now, we will still be undervalued. You understand me? If right now Clover, it's growing 0%. If we dilute right now, by 500 million shares, we would drop 15%. And right, that's how low we are. We would only lose 50%. Okay, which is insane. Okay. Healthcare isn't doing hot in my area. We have a new hospital and they keep running out of money to finish building. Yeah, I mean, that's a lot of hospitals are losing money, right? So, man, I'm starting to give up badly. Yeah, I mean, investing is not for anybody, so it's tough, man. That's just how it is. And Warren Buffett's side, it's impossible to find diamonds in the rough now. It really is. You really have to, Chamath trick. Yeah. So the thing with Chamath is, like, if this company, let's say with the share dilution, we'll do a 50%, dilution, and let's say it grows 25%. Yeah, so it's trading near what Chamath kind of brought it public almost. If you do 45% and divided by 2, it's around $8, which is around what Chamath brought it in, right? Let's see here. So yeah, they have relatively no debt, Clover, right? So so this is pretty much what I wanted to say. So a lot of people are upset about a 6% dilution for stock-based compensation. A lot, they're upset at this, but ultimately, let's open up Reddit here. And let's go ahead and go to Clove. And let's go ahead and open this up. So, you could see Andrew now is using the words AI, 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 AI. And throughout, he gave a talk to a bunch of doctors. And ultimately, these doctors now are saying that Andrew Toy is the only computer scientist running a health insurance company. So software engineer, whatever you want to call it. So I think that Clover is ultimately creating itself a moat Doctors are starting to talk about their results with Clover, et cetera, PPO. There's a lot to look forward to. For me, I want to know, with 100% dilution, am I still going to make money? So I'll give you an example. Let's say right now, instead of a 100% dilution, they dilute us 200%. That's not going to happen. Okay. If they dilute us 200, we get 2 billion shares. Even with 2 billion shares, you could see an $8 stock price if they grow at 45%. So, you would have to dilute, oh God, you would have to dilute like you would have to do 10, you have to do, you would have to do, 10 billion shares and grow at 45%, and you would still be at $1. So if Clover dilutes shareholders by 10 billion shares, which is raising $9 billion in cash, which won't happen, then even with a 45% growth rate, Clover would be $1.62. Yeah, I'm not worried. Okay, I'm not worried. Okay, so that's why, like, that's kind of why that's what I'm doing, right? So, and Richard brings something important. What about SaaS? Well, the reason why, like, we haven't even talked about SaaS. Where in this equation does SaaS go into? Well, it goes into here. Okay, SaaS goes right here in the estimation of revenue, of free cash flow. I use 5%. In this calculation, I am not estimating SaaS. So it only can go up from this calculation. I'm not going to go ahead and estimate it until I get more proof from the company. I know they hired the whole, the director and everything, but I'm excluding them because it's only going to make the stock price go higher. Okay. So again, reverse stock split, I have no idea. A couple days from now, then you have 180 days. But the reverse stock split does not change the calculation. It just changes the overall price targets, because not only do the price targets go up, your average share price goes up too. So the equations cancel out. So that's it. So that's pretty much what I have for you guys. I just wanted to point this out. Because we had a discussion today in our stock terminal, and I felt like this would be a good video to do. So just very quickly, believes, say that 5 times, that we're going to do a 1 to 10 reverse stock split. So right now we're at 500 million shares. Let's grow us at 0%. Okay. We have 500 million shares. If we do a 1 to 10 reverse stock split, it's going to be a 50 million shares outstanding. With 50 million shares outstanding, let me go ahead and remove this here. The stock prices now are going to go anywhere. It'll be $13, right? All the way up from $5 to $13. Again, amplify your share count by 10. So if your average is $1, then it'll be a $10 average, right? So you could see the numbers, the ratios stay the same. This doesn't make sense to you, blame your elementary school education, okay? All right, so then he was thinking that they're going to dilute shareholders by 25 million. And institutions are going to come in, and that's what's going to give you the 30-40% institutional holdings, right? But I'm saying, let's go ahead and let's dilute shareholders. Let's dilute them by freaking 100%. So it'll be 100 million, okay? You go ahead and do that, but if they do dilute us, we know that they're going to return to growth from the earnings transcripts. Their return to growth will be 45%, meaning the stock price from the bull case will be $162. But remember, this is including the reverse stock split. If they don't do a reverse stock split with a 100% share dilution, it's back to $16. Divide by 2, $8. I hope this makes sense. If I'm sorry if it doesn't, but that's how the math rolls, right? But that's it. So that's pretty much it right there. So that's all I have for you guys. But oh my God, this is it. This is all I have to say. So even with the share dilution, we're okay. Now imagine if they don't do a share dilution. Holy shit! If they don't do a share dilution, then this is going to be very sexy. It's gonna be more than a 10 bagger, right? All right, guys, 5 to 10 bagger, way more. All right, folks, pleasure talking with you, and I'll see you on the next one.